All right, so I welcome you for this class again. We are 8 minutes into this into our time, so I welcome you. Hope you are rightly prepared for this section. So this section will be doing practicals. All what you have learned in ICT, we'll be doing some practicals. We will be practicalizing it, and it's this is major chart work. So maybe anywhere we stop, we will continue from there in the next class as well. But we'll be doing chat work. So what you just have to do is just stay focused, remain focused, get the concept, pay attention so that you have questions because when you pay attention, one of the product of you paying attention is you have questions. So all what we have learned here, we'll be practicalizing it in the chat. We'll look at the concept, we'll practicalize it, and then we'll see how we can use this for our advantage, right? Yeah, so that's what we are doing today. All right, before we start, I'll just call one of us to pray for us. So, okay, Stanley, you're active. Please, can you just say a word of prayer before we start? It's like fulfillment is not close to his phone. Maybe he's having network issues. Yes, thank you.
In the name of the Father, the Son, and the
The Holy Spirit. Amen.
Holy Spirit. Father, Lord, thank you. You have guided us throughout the day. We are now about to start our class. Say, may you guide us, give us that sense of understanding so we can understand and follow whatever is going to be taught. I pray in the name of Jesus. Amen. And finally, may your name be highly glorified in Jesus'
Amen.
name.
Amen. We ask for the spirit of understanding and comprehension to assimilate whatever we taught in Jesus' name. Amen. Amen. In the name of the Father, Son, and the Holy Spirit. Amen. Thank you so much, Stanley, for that wonderful one. All right, without wasting much time, this is already 10 minutes, 11 minutes into our time. So, like I said, we will be examining all this approach. Remember, first of all, um, this is an introduction into the ICT trading concept. First, now we have that this is technical trading approach. So part of what we'll be doing, the technical aspect of what we'll be doing consists of 80%, right? Yes. So the technical constitutes of 80% and the rest constitutes of 80 of 20%. That is technical 80% and fundamental 20%. So let me just go ahead and put this now. Technical slash you know we have majorly three types of analysis. We have the technical analysis, we have the fundamental analysis, and then we have the sentimental analysis. So in this time, we'll just be considering the technical analysis. So we'll not be using the sentimental analysis for our trading. So technical, fundamental, what are you seeing? Seeing 80-20. So now we are about the technical approach. And the first thing we are considering is what? Is the ICT trading concept. Remember, the ICT is the inner cycle trader. Is a methodology developed by Michael G. Huddleston, which examine on all of this concept, market structure, the three phases, stuff like liquidity, stop loss hunt, market structure, order flow, Q zone, okay, entry model, then Q zone, and whatever. So now we'll be examining all of this approach now from chart work. Please, I urge you again, once again, to pay attention. So first of all, now looking at this concept, these are the key. This is the content we'll be using in examining this our approach now. First of all, what are we seeing? We are seeing liquidity. The inner cycle trader is the trader. He profounds that market price will always move from liquidity to liquidity, right? Yes, he profounds that market will always move from liquidity to liquidity because it's a mechanical system. The price is being attracted to liquidity. What is liquidity? Liquidity refers to the active orders in the market, where people's where people enter position from, where their stop losses are, where limit order are, those point or areas become attractive to price. and market will always move from those liquidity to liquidity. And according to ICT frame most of the types of liquidity, which this liquidity, which they are subcategorized into. Okay, first you can have the swing high. Of the swing high, the swing high, the swing high, swing low, the fair value gap, the volume, the imbalances. Let me just put imbalances. Balances. You can take note as well. So this is a summarized approach from that from this material, the intermediate course on ICT trading model. So fair value gaps, imbalances, which we have the volume imbalance, the gap imbalance, and market spillage, whatever. And as well we have the order blocks. Yeah, so this is what we have, the order blocks. Okay, so these are the different zones that we can make reference to in the market as liquidity zone. So first of all, what do we have here? We have swing highs. Let me go ahead and change this thing so that you get to see it well. Okay, yes, you are seeing this now. So we have the swing high. The swing high. What is the swing high? The swing high is a three candlestick pattern. A three candlestick pattern where the middle candle, wick or body, is higher than the two others. So this is the structure of how the swing high is. We have it in this, we have it in our manual here. So this is the swing high, right? This is the swing high structure, and also this is the swing low structure. And what the ICT say? ICT say price will move from liquidity to liquidity, and as much when you see maybe price is trading anywhere around this zone, it will always be attracted to this swing high. Why? Because there's liquidity resting there. So how can we point out these swing highs in real market time? How can we point out these swing highs? So looking at this chart now, we will just be considering three candlestick pattern, and we just want to see the structure, right? Either the wick or the body is higher than the other the other ones. So let's mark out the swing high points we can identify from this market. First, I can see this is a swing high. you know I can see this is a swing high. I can see this is a swing high, right? Yes. So where is another swing high? I can see this is a swing high. Just pay attention. So this is for swing high. What of swing low? A swing low is also a three candlestick pattern, but this time the wick is beneath the two other candle bodies, or the two other candles wick. You understand? So the middle candle is lower than these two. You get the point? So this is swing low. Is the opposite of swing high. So let's go ahead and mark out this swing low as well in this chart. So marking out this, this is our swing low. This point now, you see this. Okay, this is our swing low. You can see as many as as you can see as much as you can think of. So all of this now, this is our swing highs and lows. This is swing high. So remember, what is swing high? A swing high, according to ICT, is a liquidity zone, right? A swing high is a liquidity zone. It's a mechanical area in the market that price will automatically gravitate to, right? Because there's liquidity resting there. If we should get a buying, if you should see the swing high being formed, what do we say is swing high? Okay, from this manual we say swing high, a peak where price reverses downward. Say swing high and low are key points on a price chart where the market changes direction. Okay, so looking at this chart now, we can see this swing low, that after this swing low was formed, market changed direction. So I used to tell you people before that a swing high indicates a bullish bias. So maybe when you see a swing high form, you begin you can say that okay, somehow the market is having a bullish bias, and at the same time when you see a swing low, you can say the market is having a bearish bias. When you see a swing low, the market is having a bearish bias. When you see a swing low, the market is having a bullish bias. A swing high, the market is having a bearish bias. So you can see all of this. So this is what this is swing high. Okay, this is equal high. This is equal high, but we can call this now swing high because this is 1, 2, 3 candlestick pattern. And because we are seeing this now, we can see that market is having a bearish bias. You can see that at least to some point it worked, right? So this again, this is what this is a swing low, and you can see that after this swing low, it indicates a bullish bias. So now these are some of the points I can mark in this market. These are some of the points I can mark in this market. So after marking this now, what are we doing? What are we using this to do? We are using this to, we are using this as part of the confluences we can consider as our trading pattern or as our trading framework, right? When we are talking about liquidity, we say price moves from liquidity to liquidity. So somehow if I should come to this current market, I can see that this market is trending upwards. So what is my concern? My concern is to check, okay, what liquidity is price trying to, is price heading to? So now I will change it to maybe the 4 hours because I cannot see anything in the recent chart. Then I will now compress the chart. I'm trying to see what has happened before in the future, whether there are swing highs or swing lows. Okay, this is fine. So what can you see here? You can see that this is past price reaction. So I'm seeing this swing high, here, and you can see this swing high is just like it's a double top. It's a double top, and as well, okay, but you can see that this is a swing high. This is a swing high, but then it's a double top. That means I say it's a double top. I call it a double top, and this is a point of interest for us, right? Because because this is a good liquidity zone. So first of all, I'm seeing this swing high. I have marked it, extend it to the future, and as well again, I'm seeing this other swing high. Okay, this just double is equal high. So I'm seeing this other swing high again. So I will just mark this and extend it to the future to see price reaction at these different levels, because that's what ICT say, the market to move from liquidity to liquidity. So and as well, this point, this is another swing high, but let's just work with this and let's see how market has reacted to this. So now I'll now come back to the current chart. So now this is the current chart. What am I seeing? I'm seeing that market has raised this swing high. You know what rate is? I will talk about rate. So market has raised this swing high, right? And you can see the way it's rejecting. Why? Because it has reacted to liquidity. Because what? Market to move from liquidity to liquidity. If market has raised this liquidity, what will they do? It will go for the next liquidity, because that is what that's what price will do. Price will constantly be seeking for liquidity areas. So this is for swing highs and swing lows. You can see how I've marked them up. So at each different time frame, you see different swing highs and swing lows. So you can see this is a 4-hour time frame. You can see that okay, this is swing high now, this is swing low, this is swing. So you can just see now this is a 3 candlestick pattern. Now this is market gap, but this is a 3 candlestick pattern. 1, 2, 3. And what are you seeing now? You are seeing a swing low here. What do we say swing low represent? It represents a bullish bias. After this swing low was formed, boom, market started buying. After this swing high was formed, boom, market started selling. After this swing low was formed, boom, market started buying. Swing high, market sold. Swing low, market bought. Swing low, market bought. Swing low, market bought. Swing high, market sold. Swing high, market sold. Swing high, market sold. So you can see that this now, and we can get different swing highs in different time frames. So this 4 hours now, you can see the market structure. One day again, we are still going to see this. So this is swing high. What happened? Market sold. Swing high, market sold. Swing low now, market buy. Swing high, market sold. So that's why we say a swing high indicates a bearish bias. Swing low indicates a bullish bias. So let's put this as one of the concepts we'll be working with: swing highs and swing lows. So what is the other next concept of liquidity we can make reference to in the market. It is the fair value gap. Fair value gap. So what are fair value gap? Fair value gap, they are imbalances in the market. Fair value gap. Under fair value gap, we have two different types of fair value gap. You know of this already. Let me just emphasize on this. We have the CB and the BC. So forget these names. They look like all these our secondary school is this storybook CB and Ali, but this is CB and BC. So this is abbreviated with capital letter because it indicates individual meaning. So what is the CB and what is the BC? The CB is sell side imbalance, buy side inefficiency. Get the point? CB is sell side imbalance, buy side inefficiency. The BC is what? The buy side imbalance, the sell side inefficiency. And it is called, all of them is called fair value gap. Looking at this now, you know, looking at this, we have fair value gap here. Okay, looking at this now, you can see fair value gap. This is what CB and BC, the sell side imbalance, the buy side inefficiency. The buy side imbalance, the sell side inefficiency. So you can see this is what CB. What is CB? Sell side is imbalance. Why? The orders, selling orders have been overloaded in this market, and you can see there's an imbalance reaction at this point. That's why you can see this gap being open. So what it means is that this is sell side is imbalance. It's just like maybe you want to set up an equilibrium system, a kind of maybe pulley system. You need to check the coordinates right to see that it is well positioned in the right dimension to give you balance. So with that now, looking at this is CB, this imbalance now, because buy side is inefficient to fill this, and at the same time this is BC, buy side imbalance, and sell side now is inefficient to fill this. All right, so let's look at this example now in the chart. So remember, this is 4 hours. You can see all of this in different time frame, but let's use the 1 hour time frame for let's just use the 1 hour time frame in doing what we'll be doing now. So this is what we can see. This is what please, I need your reaction now. I need your reaction. What is this? This part I'm just marking, what is this? Are we active in this call? Are you guys getting it?
Fair value gap.
Okay, fair value. Like, what is it, a CB or a BC?
BC.
Is it a CB or a BC?
BC.
It is a
You say what?
BC or something. BC.
Is it a BC or a CB at this point?
A BC.
Okay, it's a BC. Why? Because it is buy
BC.
side. The buyers has overstretched this
buy
length.
side.
Then this is buy
Yes.
side now is imbalanced with this gap, and sell side now is inefficient. But now, what do you notice? What do you just notice from me now? You saw that after market left this gap open, market came back. Sell side now came back to balance, to tap on this fair value gap. So that is what now is making this price now efficient to drive up higher. I don't know if you get the point. So what do we say? We say market to react from liquidity to liquidity. We are just examining the different liquidity we can make reference to the market. So first of all, we say swing highs and swing lows. Second, we say fair value gap. And now you can see a practical example. This is a fair value gap, a buy side imbalance, a sell side inefficiency. And what the price did, it was buying up to this point. It came back and tap on this fair value gap because there's an imbalance, because this is a liquidity zone. It's a mechanical zone that market will always seek. So after market tapped this point, you saw that it went back up. After going back up, what do you notice from me again? I noticed something again. I noticed that there was another fair value gap here. Let me keep this work clean. So what is this now? This point, this is another BC, right? And what happened now? Market still came back and filled this liquidity point, right? And then it is moving higher. So you see that it's a mechanical system. Market not is just moving with these zones meticulously one after the other. After reading this one, it will go for the next one. Okay, let's say now this was a fair value gap. After market read this zone, what happened now? We can see that this is a swing high. So maybe if you have looked for a trade here, catching this buys, maybe you can exit here because this is a liquidity zone. If market take out this liquidity, what will you do? It will go for the next liquidity target. And what happened now? From liquidity fair value gap, it took out swing high liquidity, it came back again, tap on this fair value gap, and now it is going up. This is another liquidity, it has taken this liquidity, but now we call this break of structure. And now overall from the past data, we can see that it has slammed a swing high. So that means since this swing high is in a bigger picture, so maybe from this point now, markets might have a kind of retracement. So this is just the 1 hour time frame. If we should check this on the daily time frame, you can see that we have imbalance now in the daily time frame. See, all these points now is what? This is a fair value gap. So you can see that this buying has been overstretched. This buying has been overstretched. You can mark this point as a fair value gap, right? As a daily fair value gap. But then if you are marking this point as a daily fair value gap, if you change it down, if you narrow it down to the 4 hours, you see that this point is not exactly a fair value gap, right? So you can now narrow it down again. 4 hour. Now what are you seeing? This is where the fair value gap is. Okay, this one was slightly tapped. So it was tapped, but it was just tapped maybe like 10-20%. Then what can we say again? Okay, this is another fair value gap, right? This is the 4 hour, but I say let's stay on the 1 hour for for clarity and understanding. So maybe you can go and backtest it later in different time frames. So now we have just talked about swing high, swing low, fair value gap. So what of imbalances? Under imbalances, we have the gap imbalance, we have the volume imbalance. So what is, let me, now we are talking about this example. So let me look for any of these imbalances and let's see. Okay, so what is this now? What is this? You guys have learned all of these things now. What is this? This is what we call the gap imbalance. This is the gap imbalance. You can just see this is a mechanical system. I see they say price to move from liquidity to liquidity. So assuming now we saw this market gap, we know that there's liquidity at this zone. We saw this swing high. What the price do? Price when it took this swing high, it came back, it balanced on this, it came and read this this gap imbalance, and then boom, form a swing low and then start pushing up. Remember, we spoke on confluences. We say a confluence is it gives you multiple reasons for you to enter a trade. And for you to enter a trade, you don't need to use only one confluence. You need to validate your trade setup with multiple confluences. So assuming now you say, okay, you want to take this trade for a buy. First of all, I say, okay, it has raised this liquidity. What do? You say, okay, it has formed a swing low. So what are the other approach for you to do? That is why we are having this class now. So I know that, okay, market might likely come to this point because this is a swing high. Market might likely come to this point because it's a swing high. And if you notice now, after this market boom, it took out this liquidity. What happened after taking this now? You saw it. It was trying. It took this liquidity. It tried to rebalance a little bit as if you want to sell. Then it has filled another liquidity at this point. Then it pushed higher again. What is this? This is swing high. As it took this liquidity here, you saw that there was small reaction, but then the buyers were in control. It continued going up, and then you see this. So what is this? This swing low, and then markets continue driving. So now we have examined the different liquidity in the market. So volume imbalance. This volume imbalance. Volume imbalance is, I don't know, volume imbalance is hard to see at some point. This is volume imbalance. So a volume imbalance, it's a two candlestick pattern where the wick of candle 1 and candle 2 overlaps each other. This is a volume imbalance. So at this point now, what you need to do is that if price is ranging below, you know that, okay, there can be a reaction from this zone. Maybe when market taps this place, because there's a liquidity, that zone is a mechanical zone of liquidity where liquidity is resting. So you can see that when market taps this zone, it can be a reaction, maybe down. You get the point. So, and as well again, maybe if market is trading above, depending on how it's been formed, you know that if the market should come to this zone, there can be a reaction to the upward direction, right? Yeah, so this is volume imbalance. can take note of this. I don't know if it was there in the manual, but you can take note of this. This is volume imbalance. So I've showed you volume imbalance and gap imbalance. So the next one is what? Order block. Order block. So you know what order block is? Order block, we can call them order block or we can call them supply and demand zones. They are where institutional buying pressure was pushed into the market. So now you see market was consolidating at this zone. You see that from here momentum step into the market. So this is an order block. Just stay with me. We will put all of this together now. We are just examining this concept. So now we saw this consolidation. What happened? Market. This was where momentum entered the market from. So this is what? This is an order block. So we saw this consolidation around this zone. This was where momentum entered the market. So what do we call this? We call this an order block. So this point now, what do we call this point? An order block. Why is it an order block? Like I have mentioned, it is a zone where orders, blocks of orders was being pumped into the market. You understand? Because this market was in an indecisive, it was indecisive. There's what we call indecision candle. An indecision candle is candle that is either giving you a bearish or a bullish bias. So seeing this kind of, price reaction. But then after this candle, the last candle before the impulse move, this was the impulse move. So that means order was being accumulated at this zone. And so what do we call this? We call this order block. And as we're looking at this again, this is an order block. Just get the point. So now we have successfully marked out the different liquidity zone according to ICT. And what did I say? ICT say market moves from liquidity to liquidity. You get the point now. So after examining this liquidity, I want us to just talk about one thing. What we are going to talk is RAID. RAID. So let me write it so that you see it by yourself. I've talked on this in one session I had with you guys before, but I don't know if you guys still remember. So this is RAID. What is RAID? RAID, RAID you can put, by the word RAID. You know what RAID means. Oh, how will I explain this now? Okay, RAID is like it's an attack of a particular system. They can raid you of your phone. The raid is like robbery. Let me put it that way. Or it's a kind of unique kind of search. You understand that has to do with that has to do with some kind of computers um flow. Yeah. So in this aspect now, how are we seeing RAID? RAID is a tap into a liquidity. So when we see a swing high like this being taken, we say what? We say market has raided this swing high. Get the point? So when we see this fair value gap being tapped, we say market has raided this fair value. When we see this swing high, as this market you say it went beyond this swing high, what do we say? We say market has raided this swing high. And at the same time, let me look for another raid examples. Okay, now you can see this swing high now. You can see this swing high here. I mean this swing low. So what happened now? We can say this market has raided this swing low. You get the point? So this is what we call as raid. Raid is a tap into a liquidity. It's a tap into a liquidity zone. Yes, RAID is a tap into a liquidity zone, and this is the framework of ICT. ICT say price moves from liquidity to liquidity. So after price finish attacking a particular liquidity, we call that RAID. So after that RAID, what is the next thing that price will do? Price will then turn to the next liquidity closer to it, or to the next liquidity of interest. So it's just like this now. Okay, let me say there are some drug dealers in a particular zone, and police came and invaded that area. It's a kind of like estate. So police invaded the first, maybe the first house, and maybe he found some persons that was doing drug, and they captured them, right? So what do you think police will do? He will move over to the next house, right? So we say that okay, police has raided this first house, and then it has moved over to the next house. So it's the same thing with this market system. when price raid this liquidity, this swing high, what is it going to do? It's going to move over to the next liquidity like this now. Like I just love this system. This was a fair value gap. Price raided this fair value gap, came back, raided this swing high. What again? It came back, it raided this fair value gap, this BC, and then it's pulling up, and it has pulled up now in the higher time frame. It has raided a major liquidity, a major swing high, and now we can see the momentum. So what do you think this price is going? So let me just help you. The price is either coming to maybe attack here, but we'll still put things under perspectives, and we'll put it not with this knowledge. It's not like I'm telling you to go and trade, but we'll put things under perspective. But then after market has raided this swing high, what market to go for the next liquidity zone, and this is a zone of interest, and as well this is a zone, this is a swing low, is a zone because there's liquidity here, and as well this is a zone, and as well this is an order block. You get the point? And as well this is a zone, this is a zone. So our own is just to watch and see, when we get our conferences right, we take advantage of the opportunity, how it presents itself. So now we have spoken on the types of liquidity, spoken on order block, and now I have talked about the concept of raid, which raid is a tap into a liquidity. So this is just one aspect of this concept, right? So we'll be going further to the next one. And which is the next one? The next one is market structure. I know that you know about market structure. Market structure is very paramount. Market structure indicates several things. Indicates market momentum, indicate the directional bias of the market, overall it. You understand? Like market structure is so wonderful. So entry models. Alright, so we'll be looking at market structure. So you know what market structure is? We have just three phases. We have the bullish market where price continually form higher highs and higher lows, right? You know of this. You have the bullish market. And what again? We have the bearish market. So what is the bearish market? The bearish market is the inverse of this. So this market was buying, but now you see market now is now forming lower highs and lower lows. Lower highs and lower lows. You get the point now. So what is this now? This is a bearish market. So and at the same time, what is this? This is a bullish market. You get the point. So this is a system. We can spot this system for market by determining the highs and the lows market is forming consecutively, and we can spot this. If it's this high first, this high was broken, a higher high, then a higher low, a higher high, a higher low, and at the same time the inverse of this is the same for a bearish market. So and then the other market phase again we have is what is the this one has many names. Is the you can call it accumulation, or we can call it the ranging market, or you can call it the consolidating market, whichever. And it is mostly, you can see this mostly in the Asian zone, that is for for New York pairs. So now look at this now. This is a ranging market. So you see a ranging market forms equal highs and equal lows, or it range in a particular zone. You see that this one is just neat. That's how you can position to catch trade in a ranging market. You see that this one is just neat. But then this is another example of a ranging market. So how can you trade this kind of market? There's no clear direction. So a ranging market is not a good place for you to be. This one is neat now. You say you can sell here, you buy here, you sell here, you buy here, and you make profit. But what of this kind of one? If you sell here now, okay, it's okay, you now buy here now and you're targeting here, your stop loss hit. You now buy again, and stuff like that. So it can be complicating. So this is a ranging market, or you can call it a consolidating market, or you can call it an accumulation phase according to Wyckoff's theory. All right, so this market structure, we'll be applying this now. Let's look at this market structure in our chart. Okay, so I would like us to do something now. I'd like us to do something. So please pay attention. Pay attention. Like I said, your understanding is very, like I need you to gain understanding. Yes. So this is what I want to do. I want to change my background. Symbol, sorry.
You have passed background in that Canva.
Okay, no, it's not background. Sorry, I want to change this candlestick.
Okay,
So
okay.
I want to get another template. So 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 now I want to do something. So this is what I want to do. Body of this candle. This. This is the same. So what can you see now? You are not seeing any red and you are not seeing any blue again. I want this to be exactly the same. Is it this? Okay. Thank you very much. Okay, so what is this now? You are not seeing any red candle. You know, this perspective can help you mark market structure like wonderfully. So now what are we doing? We are not focusing on any red and any 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 red and green candles, but then we are just focusing on market structure. Get the point? So first of all now, you know, market structure is when market forms highs and lows in the market. Bullish market, higher highs and higher lows, and bearish market, lower highs and lower lows. So looking at this first, we can call this a high. Get the point? So this is a high. So what is this now? We can call this a lower high. A lower high. So what is this now? We can call this another lower high. So we can call this higher high. So higher high. Okay, we can call this is the first high. This is the high. This is a high. This is a lower high. This is a lower high. You know, this is a lower high. Then what do we see at this point? This what do we see at this point? This high was broken. So what do we see now? This point now is what? Let me delete this. Okay, so what is this now? This is what? This is a low. This is a low. This is a higher 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 low. Hope we can all see this now. So what is this now? Here is a higher low. I mean, it's a higher high, sorry. Please pay attention to this. It's very important. No market structure Market structure is very it's very important. You cannot trade without market structure. It's as if you are trading blindly. So I notice where am I marking this high? At the swing highs, at the swing highs, at the swing highs and at the swing lows. So what can we say about this kind of market? From here, what do we see? We first of all got a high. Okay, we can check this from the future. Okay, yes, okay. We first of all got this high. After getting this high, what do we see again? We now saw a lower high. Okay, I can see this other high here. Okay, this is a high. This was a low. Okay, this is a low. So this is what now? This is a high. This is a lower high. This is what? This is a lower low. And as well, this is a lower low. So this is it. A high, a low, a high, a low, a high, a low. You get the point? So now this is a high, this is a lower high, this is a this is a high. I mean this is a lower low because this was the other low that we can see from this. So now this is a high, this is a lower low, this is not the lower low, this is not the lower low, sorry. First of all now, because we are looking at this market, I want you to gain this understanding so that you know how to go with this approach yourself. So first of all now, this is current than this one. So this is the high we first saw. So where was the lowest point this market went to? This was the lowest point. This is what now? It's a lower low. So now which point is this? This is a lower high because this is a high now. This low now is lower than this high. So now this is a lower high. So after this market broke this structure, continue going down. So where is the other low again? This is the last point. This is the least low. You cannot call this a low because you cannot call this a lower high. You get the point, and you cannot call this a lower high. Why? Because this point now, this point is higher than this. So this is the low, the lower low, and then this is the lower high. And as well, this is the low. Why I'm putting this a low, I would have put this a lower low, but this is the last low now that we got because we are seeing this already from market reaction. So now this is a low, and after this low, what happened again? Market form a higher low. So you can see that somehow market is trying to shift trend. And what is this now? When in a trend like this, and then you see market breaks this previous low, what do we say has happened? We say that there is a market structure shift. Somebody have question? Don't worry, it's not time for question first. Just let me just hurry up and so that we can just get the concept. So if you see this now, what will you say? You say this is a market structure shift, MSS, or you can call it a change of character. People have different names for it. So now this is a change of character. We call this a market structure shift. When market has been going bullish, and then this breaks with a body break, we call it a market structure shift or a change of character. So in this case, we are waiting for pullback to continue the trade. And at the same time, this is for a bullish market. At the same time, this is for what? This is for a bearish market. So market has been trading downwards, it has been trending downwards, trading downward, and then we saw this boom. This is what now? This is a market structure shift. It shows a sign of strength. It shows a change of trend as well. You understand? So maybe you come to this point now and be looking for entries. You get the point? Or maybe as the case maybe we'll talk about entry model later. So what happened now at this point? This was a high, a lower high, a lower high, and then we were expecting this lower high to hold, and maybe market should come to these points like this. After this lower high, this is a lower high. We expect that okay, after market drop down, market should come here, react from here, and continue going down. You get the point? But what happened now at this case? at this instant there was no breakout, of this zone. Rather, market changed character. So which high are we seeing that market change character? This high. We cannot call this a break of structure. Why? Because it did not close with body break around this zone. So we not call this a break of structure. Rather, it broke around this. Is this candle that broke it now? This candle. It was this candle that broke this high. And if you notice now, we can call this equal highs. So this equal highs now was being broken by this candle with a good sign of strength. You see the momentum with a good sign of strength, and it did not even retest, it just keep going up. So now at this point, what do we say has happened at this point now? We say MSS has happened. What is MSS? Market structure shift. You get the point? And it's this candle that, okay, so we can extend this for clarity purpose. So we can call this what? A market structure shift. I don't know if you are getting me. Oh, this call is ending in the next 6 minutes. Okay, let me just rush with this market structure. I can still initiate another one. So after this market structure shift, what happened now? Market has changed trend, and this is what market structure is all about. So what do we see? We got a higher low first, higher than this low. We now got another higher low. We now got another higher low. We got another higher low, and at the same time, we are getting higher highs corresponding to each higher low. Higher high, higher low, higher high, higher low. So you see the progression now. Higher high first, then higher low. Higher high first, then higher low. So at this point now, this is higher high, then this is higher low. Then where is the next higher high? This is not the next. This is not the next higher high. Please, I beg you, get the concept, because if you not get this now, there will be problem. This is higher high. This is higher low. So where is the next higher high again? This is the next higher high. Yes, this is the next higher high. Then this is the next higher low. Or because this failed, you can say this is the next higher high, and then this is the next higher low. Then what again? We say this is the next higher high, and where is the next higher low? We say this is the next higher low, not this one, because this one did not form any significant low. So this is the next higher high, this is the next, okay, this is the next higher low, then this is the next higher high. Then you see this again, a kind of change of strength, a sign of strength. This is the next higher low, next higher low, higher high, higher low, and then you see we just reacted from, like I was telling you, this is a good zone, a good liquidity zone. So what do you think market to do? Market to move to the next liquidity. So market might come to this point now like this. This is one of maybe your confluence. It might come to this point, maybe come down, come to this other block, react, go up, or maybe react, continue coming down, because there is liquidity piled up at this zone. You understand the point? This call is ending in the next 4 minutes. But let's just, okay, now, so this is for market structure. You get the point? This is for market structure. Market structure, you need to know how to mark it. Like, you need to know how to mark it. Like, you saw this point now. If you are marking a higher high, so what of this one? If you are marking a higher low, then what of this low? So we ignore all of this, and this is the real significant low. This is the significant high, not this one, because this one now that formed this low, and this is the low. Okay, this is the low now, because this one, this low is lower than this low, and then this high now is not, this is not the higher high, because it has not broken this our last zone of interest. So what's the next higher high? This is the next higher high, this is the next higher low, then higher high now, and we don't know what to happen next. So this is market structure. So now, so far, what have we done? We have done the different liquidities according to ICT. We have spoken on market structure, and as well examined the change of character, that is the market structure shift. And this is what we are having here, market structure shift. There's a sign of strength. And okay, so market structure shift. Let me look for another market structure shift example. Okay, now looking at this now, what is this? This is first of all a high. This is a lower high, a lower high, lower high, lower high, lower high. So what happened now at this point? There was a market structure shift at this point, and we can tag that to this candle, to this good bullish candle. So after this market structure shift, you see that there was a sign of strength, and market start pulling up. So this is an example of market structure shift. So now market has been trending upward, upward, upward. This is the next lower low. Then market broke it. What do we call this point? We call this point market structure shift. See, for you to trade well, you need to spot out this kind of reaction in the market, because this is our trade. This is my trade opportunity. If I see this breakout, I know that, okay, market is changing trend. We call this either a reversal or a continuation trade. So after breaking out, we wait for retest to this zone, and if you have taken a sell from this point, our call will soon be ending, but just be patient. I will have to set another call, initiate another call. Then we'll target maybe any of this liquidity zone, and you can see maybe 1:3, and market came, and boom, our TP. And after you see this break of structure, what are you looking for? This was the retest. You take it now to either this swing high, swing high, swing high, swing high, their point of liquidity, and boom, market even came to this one, and boom. So this is market structure. So what is the next concept now? We'll be looking at AMDX. AMDX. So look at this now. AMDX. So AMDX is what? Is a 3 or 4 phase of market according to ICT. That is the accumulation, the manipulation, the distribution, and the continuation or the reversal. So this is what we'll be looking at. So let me go ahead and initiate the next call. So see what I was saying now. Market has reacted to a good liquidity zone. So what do we get? We get this reaction. Market is going for the next liquidity, and this is the next liquidity. So maybe after this, you might have a little retracement down to maybe this other block, then continue structure. I'll just finish market structure. So the next one is what? The AMDX. AMDX is the 3 or 4 phases of the market. This is the AMDX. ICT maybe have okay. The AMDX, there is a theory propounded by Wyckoff. It is called the Wyckoff's theory, and it is a theory that profounds market reaction. It profounded it for stocks anyway, but it's a system that works even in most of the asset trading, the financial asset trading. So this is how the system works. So after a kind of maybe a selling climax, the market will go into an accumulation state. The accumulation state. Accumulation is when market do not have any clear direction. Market will just be accumulating. And so what are we seeing? This is a range. This is the accumulation stage. So ICT says after this accumulation, then there will be a manipulation, and then a distribution. Then after this distribution, market can now do 2 things. It can either reverse. So this is how the reversal is. A break of structure. It can either reverse, or maybe from here you can just continue the trend, or maybe from here you can just now, maybe from here it continues the trend upward. So this is what is here: accumulation, manipulation, distribution, continuation, and reversal. So at this point now, this was the accumulation point. So let me mark this in this range. This is the accumulation. So after this accumulation, what happened? Um, um, Institutional traders, they tend to manipulate. They have been buying order at this point. If somebody is buying here, stop loss is below this zone. So somebody is buying here, stop loss is below this zone. Somebody is buying here, stop loss is below this zone. So they tend to manipulate. This is what we call stop loss hunt. It is either called stop loss hunt, a spring according to Wyckoff's, stop loss hunt according to ICT, or you can call it manipulation, okay, according to ICT as well again. So this is the manipulation phase, and what this is the distribution. So as a trader, you want to be found after this manipulation. Maybe you can wait for a sign of strength here, and maybe you take your trade, maybe this low, and then the target can be targeting those highs. Maybe 1:3 is 1:3 is the least trade I would like to take. So 1:3 like this, you wait for this manipulation. This manipulation sef might be lower a little bit. They wait for this manipulation, and then you are taking your trade to the corresponding direction. So this is the 3 phases or the 4 phases of the market. So I will do practical and I will check out these phases are in the market. First of all, accumulation, manipulation, and then distribution. So let's check this out now in the market. So now you see only this one chart. Now we have talked on different concept and different ideology. We talk on the different liquidity zone we can make reference, and you see how they reacted. We talked about the swing highs, swing lows, so that okay, market take this swing high to go to the next liquidity point. But now all of these are confluences. We are trying to set a good framework. You get the point. So just stay with me. So looking at this now, we are looking for this we are looking for a kind of we are looking for this phase now. Okay, let's look at this now. Okay, let me just use this. So what happened here at this point? Market broke structure. It was just supposed to buy from this point. But what happened here? There was a manipulation at this point. This week now, people bought from here. If people are buying from here, after seeing this, they will break even. But then market came and took their SL. This is what we call manipulation, and then distributed to this long range. But let me look for a good clear example. Okay, so now this trade, the day I took this trade, okay, the day I took this trade, I posted the signal in our platform, and anybody here in the platform can still remember. So this was on a Thursday. This was Euro USD. So Anibe, you remember this trade, right?
Yes.
Okay. So you notice what happened, that people say, they took me, they took me. So what happened at this point now? This was a manipulation. Was a manipulation from this zone. This was a swing high. Normally, if you have sold there, market, you see now, see this engulfing, see this pin bar. Market is just supposed to just respect this and go, but market came for this. You call this wickedness. This is what we call stop hunt. So this now, after this accumulation phase, market manipulated. You see that this one is slow, but like it's small, but you still see other examples. Then it now drove down. You get the point. So what again? Okay, see this here again. So people have been selling from here. People have been selling this market from here. What happened? This market sold here. It came back to this point. It did not break it first. So then what happened now? This candle now took their stop losses. You see. So what is that now? We call this liquidity, right? We call swing high is liquidity, because it's a mechanical point that market will always go for. So it just took this high, took these highs, and then boom, it started dropping. But from here, people sold from here. People even sold from here. After this engulfing, people sold from here. When market came back, kick all of them their SL, and it was good with liquidity, and then it now drove down. So let's look at other examples again. Okay, so now seeing this range, you know that this is the accumulation range, accumulation. So what of this now? People bought this market from here. They bought this market, and maybe their stop loss, after seeing this momentum, they'll break even. Market came back, cleared their stop loss, boom, it's going back up. So if you want to trade and be successful, you need to know how to trade like the institutional traders, because they will always look for stop hunts. It's not like they are wicked, but they just have to do it to fuel their own orders. So see this now in the market. Imagine market, you enter market for buys and you are swinging it, and maybe you have broken even. Market is here, market came down, come and hit your break even and clear this low. You see, this is wickedness, but then this is how the market works. So this is manipulation, then this is distribution. After this manipulation, you see, boom, market start pulling up. So and as well, let me look for others again. So you can see this now. Okay, market was supposed to sell. Oh, you sold from here, consolidated. What happened? Consolidated. It went up as if it broke structure. This one now manipulated this high as their stop loss, then it dropped. You see, this is those example. Okay, see now, this is wicked. See, people have sold this market from here. People sold this market from here, and as this market went down, they have broken even. Market came, kicked them. This is what we call stop loss hunt. Because okay, let me give you one analogy. You see this kind of trade. If maybe I should be in this position, and maybe I'm swinging it to maybe, or okay, I'm just holding the position, okay, to maybe this other block here. Then I've entered this position at this zone. So I now see market drop to this point. What do you think I will do? Somehow, okay, somehow I might just say, okay, I break even to remove the risks. So this is a break even trade now. So what happened now? Me, my stop loss is here. So other persons now, they are waiting for breakout. If I should change to maybe the 15 minutes, you see other people are waiting for breakout at this zone. Maybe they want to see price breakout with body break. They want to see something like this. Market breakout from this zone. Breakout and retest. There's a strategy, breakout and retest. So they want to take this market now to maybe this liquidity zone, this point. So how is their trade? They are using a buy stop. Their buy stop might be above this zone. So if market breakout, it should just continue.